Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Thursday, October 16th, 2025. And today's title is Earnings in Jerome Powell Suppress Volatility. Although, I'm not sure if that's still true today. I'm going to cover all these things. It's an interesting sort of condition we're in the market right now. And it's, I think, getting to a spot where it might be a little bit treacherous in terms of range bound conditions. There's technically not a lot of really strong signals one way or the other. So I think it's important to realize that within a TradeStation. Here you can see if you go to tradestation.com and you scroll down the homepage, you can see here we have this blog post, Earnings in Jerome Powell Suppress Volatility. You can look at that. Now let's look over here at our key ETFs, the look at the standardized returns here. Let me just look at some of these ETFs we're going to show you. My sense here is that things are actually a little bit more tricky. And I say that for a few reasons. And I think that the main thing is that I've noticed this in the market, is that when something is new and the market starts to act on it, be careful and realize that sometimes a new sort of condition starts to assert itself. And the thing that was true previously, that was common sense a few weeks ago, is less relevant. And I think the new thing right now is the risk of some kind of geopolitical worsening. And I don't want to be too specific or really know what it is, but I think when we look at the overall conditions, we have to look at some of the things that are happening here. So I'm going to first actually start off very quickly by looking here at one of the charts we share. Now, remember, if you're in the blog post and you go to the top, downloads are available here. This has a zip file. Inside the zip file, it has a series of ELDs and workspaces, and we're going to look at those. So you can load the ELD, which then brings in a bunch of custom studies. And when you have the custom studies, you can then look at the different workspaces. So one of the ones we use is MTES. This is version 2. We've had 2 versions of this. The first version only had the hourly of the S&P futures and the S&P cash. It was the first 2 charts we shared was this chart here on the bottom right and this chart on the top right. But this is basically the S&P 500 with 4 different, well, one is it has futures and it has cash. So I'm going to show you a few different things here that I think are kind of important to look at. So first of all, as we look at this, we have essentially the 4-hour chart. Now, what I did with this is I basically put on this yellow line, and the yellow line will show the location of the 10-day simple moving average. And I adjusted it so it's not actually a 10 moving average. I think it's sorry, it's down here. If you look, I adjusted it to reflect. I used a 54, and 54 when you're using 4-hour bars comes out to 10 days. I did the math and I can't remember exactly how I did it, but that's more or less true. And this will follow the 10-day. So I've always been, someone who believes that the 10-day simple moving average, I'm going to make it thicker so you can see it more easily, but I've always been someone who believes that the 10-day can be a relevant indicator. And here it's falling. And I have just found that the direction of the 10-day moving average, once it starts to move in a certain direction, it often stays moving in that direction. Now, I mean, this is not an absolute rule or anything like that, but we've rallied up to it and we have failed. And to me, at this point, that is a potential thing to be worried about. Just to realize is that that's something here that's giving us kind of a potential sort of indication. So from my view right now, the market is waiting for the next kind of headline. And so I think right now there's a sense that we could have a situation where the trade war thing gets worse. The other thing is the government shutdown. People are always trained to believe government shutdowns work out wonderfully well in the end and nothing bad happens. And that might be the case with this one. But if it continues to play out this way of kind of, I don't even want to use the word brinksmanship. I don't know what else to call it. Both sides are like refusing to talk to each other. I'm not trying to make any political judgments, but whoever side, whatever it is, it doesn't matter. What I think matters is that this thing is not getting resolved. And at a certain point, people might look at that and just the uncertainty alone means that people don't buy. And when you get to the point people don't buy, then you start to get to the point when they sell. Or remember, the market always has buyers and sellers. So if buyers stop buying, then that leaves sellers who are selling. And then the buyers who waited to buy, or you understand, it can shift direction. And I think we have to realize here is that there is a potential of that happening. I don't want to make any kind of really clear outlook because at this point, I think it does depend on that headline. I mean, Trump could say no more tariffs, or China could say have all the magnets you want. I mean, who knows? The point is in that case, there would be a certain kind of outcome that would be bullish. But at the same time, look at the direction of things right now in terms of this impasse between China and the White House, and the impasse between the lawmakers in Congress. At this point, I mean, I'm just kind of taking a step back and guessing and saying there's not a specific, an especially good reason to think that the next headline will be a good headline. And we're in a spot now where maybe the next headline is a bad headline. Maybe this situation needs to get worse, or both situations need to get worse before they get better. So what does that mean? Well, we're in a range on this chart. Let's look over here at a daily chart really quick. I'm going to minimize this radar screen. You can see. Go to the S&P, and you can see here this is now a daily range. In fact, I'm going to bring up another recent workspace that I had that I was working with. Where'd it go? This one. All right. This actually has the indicators of what I was looking at today. So it is interesting. If you look at our blog post today, we actually look at like the fact that we held this level, some key levels here. And I think it's important that there was a level here. It was a Friday level from the 26th, which was a Friday, September 26th. And you can see that basically that was important because it was a weekly close. And we basically had, if you look from that line, you can see that we basically closed above that level every day. Well, on the Friday, we closed below it and we came right back up, and that's potentially a bullish sign. But where are we now? We're back below it. Okay, that's something to be a little bit more cognizant of. You know what else I'm going to do? I'm going to add MACD. Because look at this. MACD has been falling here for a while. I'm going to just actually make this easier to see. I'm going to just thicken it up. I'm going to hide stochastic. And if you look at MACD, I mean, now, let me change this a little, clean this up, reset it. Now, I mean, look, MACD can give you a bad signal for a long time before it actually matters. I mean, this MACD's been kind of flat here for a while. But, the thing is that it's not confirming upside anymore. I don't want to make too much of an argument based on MACD because, I mean, it can give you all kinds of signals. But it's not giving us any sense that the momentum is especially strong. So the thing is, very often when you look at declines, MACD was like falling before the sell-off happened. Let me actually hide myself and you can see what I was talking about here, actually. Go back. So look here, you can see over here, you can see that MACD was falling before the real sell-off happened. And if we actually extend this out, give it like 2 years of history, well, actually we have it, yeah, look at this. If you look back, I mean, you can see in some ways that MACD had been languishing all of the fourth quarter of last year, been kind of languishing. And what it does is it creates a condition where you have people who basically are sitting on profits and they're like, well, if it doesn't really continue higher, I'm a goner. I'm out of here. So I think you have that situation with something like MACD here. And I'm just pointing these things out because, to me, it's one of these things where it's like all squares are rectangles, but not all rectangles are squares. Well, I don't want to say all sell-offs begin with bearish MACD, but a lot of them do. So you have something where, bearish MACD is not always the beginning of a correction, but a lot of corrections begin with bearish MACD. So I think that's the way to think about it. Now, the other thing is that we are in a range here. Now, if we look on this daily chart, I'm going to just move these. In fact, let's go back over to this chart. Then this is the one I'd like to work with. I've shared this with you guys. You can see here on this 4-hour chart. Another thing that's interesting is the price range got wider, which means it's just a sign of volatility increasing. And it also tracks where the highs have been. So now you can see that the top of the price range is lower. And, that is, maybe the beginning of something. I want to just kind of point that out. But this has price channels on it. So now I'm going to go to the hourly. Now you can see, look at this this is the whole bearish outside day that we had last Friday. We've been stuck inside of it. If you look on the daily chart over here as well, you can see that we're stuck inside of this candle. So, we haven't broken to the downside, but we're still stuck inside of it. And when you have a range, you have to be careful because You know, in some ways, you don't have an edge unless you're at the edge of the range. Unless you're on the extreme of the range. So, like buying this drop to the bottom of the range, that was an edge. You know, if people could have bought down there, there was a clear reason because we held the low. And at this point, though, there's nothing up here. We're in the middle of the range. Now, if you look at it on the daily chart, look at this level from the eighth, which was right around 67.20. Well, where did we peak yesterday? Right around six. Yesterday's high was 67.24, and then if you go back to the eighth, the low was 67.18. So I'm going to go back to this hourly chart, and you can see what I'm talking about here. And right here, this low, you can see right here, there was a low here on the 18th. I'm sorry, on the 8th. Sorry. So the low is on the 9th. Anyway, you can see this intraday low became the intraday high yesterday. So, I mean, to me, these are situations now where we are going into an earnings season that should be good by all discernible measures. But like I said, we've known that for a while, but the idea of a worsening geopolitical slash congressional situation, whatever you want to call this, puts us in a spot where that's now the news story, and earnings and AI are becoming increasingly the old story. So just kind of think about it that way. When something becomes the news story, it has the ability to do things that you don't expect, and that is maybe kind of where we are now. So I'm just going to mention a few other things. So today, we look at our the main title today of our webinar. Jerome Powell suppresses volatility. Earnings suppress volatility. They were good. They were good so far. So I think if you look at it, Jerome Powell basically came out and he talked about the end of quantitative, tightening, which is a positive. It's a dovish thing, which is good. And he was saying things about tariffs aren't causing inflation, which is interesting because he didn't really say that before. So Powell is getting more dovish. And so right now that is also out there. Now, again, but the other point is we've known about the Fed. It's been priced in for a while. Okay. And that, I think, is the key thing, is that when something is an old story, when it's been around for months and we've all acted on it and everyone's talked about it, it no longer has the same ability to have an influence on price and movement in the market. And so I think that's the way to think about this now, that yes, these things are out there, but we've known about them. And so that's the one thing. Now the earnings also, Goldman, Morgan Stanley, Bank of America positive. However, if you let's look over here at our key ETFs over on our MT main, what we can see here, and we actually look at today, our movers, financials are getting hammered. Now, in our state of the market, we basically had said on the weekly chart, which I don't have time to get up right now. I can show you in this week, we have a weekly here, you can see. We had basically mentioned that this, to us, we saw that this range up here on the weekly, on our Monday webinar when we do the indexes, this range up here between 53 and 55, 54 and a half had gotten tight and had gotten tight without a breakout. And it was in a spot where potentially volatility could increase. And that's what we had said. And even with good earnings, people are going the other way. So I think now there is a story that I'm going to get to, is Zion's Bank. And we're seeing another new story, credit losses. That's another new story. This is not a story we were talking about 3 weeks ago. Now it's a story we're talking about. So when things are new, they have more ability to impact. So I'm going to just kind of mention that with the financials so far. So I think we have to take a step back and just realize that this situation with Trump and the tariffs in China right now, from what I can tell, and we did talk about it in our last blog, in a blog post that we did here, this blog post about the beginning of this, we had kind of outlined the series of events that happened here. And we have an actual kind of timeline here with these different things. There's a lot of stuff. And the other thing is if what I can tell is that China planned this. So China has been planning this action against Trump. So the thing is what happens if they have a plan that we're not thinking about? What happens if they actually know what they're doing? And so I think that's an important thing to realize. It's kind of a risk out there. And the thing is that this could kind of, be worse than we expected. That's the sort of thing I think to kind of realize. And I'm just kind of looking at this from the overall picture. But this latest thing, Trump was surprised when China put these restrictions on the rare earths. And that shows that if China did something, they weren't reacting the way they had before. They were being proactive. And you got to be careful when someone's being proactive, because it means they're planning something that maybe you didn't think about. And I think that's the thing here that we have to also kind of realize. There could be more surprises from this current situation than we're expected. So I think we just put those things together. And the other thing I think is interesting is when you simply have the situation of the shutdown dragging on, the trade wars dragging on, like I said, it gets your spot when there's just no more reason to be bullish. And then, like anything with market and momentum and everything else, that can turn into something that does start to break down. So just to be aware of that. What was also interesting was the American Association of Individual Investors today put out their weekly survey. And what we saw that the bullish sentiment dropped 12.5 percentage points. That was the biggest drop since February of 2023, which is when I think the whole Silicon Valley Bank thing was blowing up. And then the bearish increase, it went up 10 points. And that was the biggest increase since February 27th of this year, which is when the trade war started. So I think, look here, let's look again at the S&P. On the daily, you can see February 27th was right here as the market was breaking down. We tried to, this was the old highs, and we crumbled down through the 50, through the 100. Okay, so I think that was here a sort of thing that was crumbling and breaking down as that got worse. So the sentiment we saw in late February spiked bearish, and today it spikes bearish. So again, these are just things of, and at this moment in time, things got worse before they got better. That's the key thing. All right. So I think that's the kind of overall thing here. And I will just say, if you look right now, we did have, for example, Taiwan Semiconductor had some really strong. Was it guidance? They had a strong report today. It was earnings with some kind of strong guidance. But now, what are we getting? A bearish outside candle. This is just an interesting one. I hadn't looked at this in a couple of hours, and here it is. A bearish outside candle at the all-time high. That's Taiwan Semi. Salesforce.com put out bullish long-term forecast about their AI growth and everything else. Now, I've been very wary of this stock overall. And I think one of the reasons is that we have seen across the entire market, companies that are connected to white-collar employment have done badly. Things like Gartner, IT, things like FICO. I mean, that's a kind of a different one, but things involve TRI, which is, financial news. Thomson Reuters. FactSet, FDS. Look at their research. They have interesting information about earnings. But so all I'm saying is things involved with knowledge workers and white collar employment have all done badly. And I don't know if it's because there's less hiring of white collar workers because of AI. I don't know if maybe their businesses have become less relevant because of AI. But I have seen this overall. So, Salesforce.com is kind of the same way. I mean, it's basically the kind of business that is involved in white collar marketing, managerial, information worker kind of jobs. And if those people aren't getting hired, those people, they do things like run email campaigns. And that's what Salesforce does. And the other thing to realize is it not maybe going to be a strong holiday season? And Salesforce is ultimately, in some ways, they're not really a tech stock. They're really a media company in a way, because they're connected to advertising in a way. So, I mean, I don't know exactly where the line breaks, but the thing is that this is a company that has struggled for a long time with a high multiple, and their growth is no longer as amazingly awesome as it used to be when you can just count on this company consistently growing. And so I think all these things together here, they had that strong guidance and nobody cared. This thing still trades at a very high multiple historically. Also, today Bloomberg was reporting that Apple is planning a robot. Now, I just want to point that out. That's the first I've heard of it. It's an interesting sort of thing. A new kind of robot that they might release in a year or two is at this point not going to have an impact on the stock. I do think as Apple, though, you got to realize is that there is some potential here of a double top at this level. And I think the other thing that's important about Apple is if I'm the Chinese and I want to beat up on any company in negotiation or anything else, I think Apple is especially vulnerable in various ways. And if people in China don't buy as many, it's just there's a lot of things about Apple here with the Chinese exposure and stuff that is tricky. And seeing the double top, the chart is telling you something, and at the same time, it's not like this has been a massive AI stock in many ways. So from my view here, Apple here is in a spot where it might be a little bit challenged, and I think it's important to bear in mind that there is this double top now forming on Apple. Now, Walmart had this whole collaboration with OpenAI, which I think is a very interesting narrative. I guess I'm not the only person who walks around Walmart talking to ChatGPT about things like tools, but the fact is that it's kind of a no-brainer to a certain extent how AI can help to market, but also help people like, oh, I want to go and do some project, and how do I use this thing that I want to buy? Like, you ask ChatGPT, how do I use these sewing needles for my daughter or something? The potential growth of this, I think, is not yet even really contemplated. So this was very interesting to see in Walmart, and I think we need to just realize that was an interesting story. And Walmart has emerged as a growth stock. I mean, this is now a major tech company. And if you look at this breakout to all-time highs here, and then it's pulling back. So Walmart 105 is something I think that might be kind of on people's radar here. Today, Hewlett Packard Enterprise had weak guidance, so this one was definitely I just noticed I wanted to mention that. And also Wedbush had done some kind of survey about you know people using more AI and stuff like that. But again, the AI story at this point I think is well kind of well known at this point. Now, I think also here, let's look back at the S&P 500 again. Like I said, there was several things on the chart. Like I mentioned, this overall candle that we're kind of stuck inside of. Now, in my rundown here, I talked about, like I said, we're holding the 21-day EMA. We're holding the weekly close from September 26th, right? But we're not holding the EMA anymore. We're under it. The 26th of February 20, like that Friday right there. It's like I said, we're back under it. So these things that I mentioned last night when I published this article, or I put it out, these things are no longer really operative. So we have this big candle here. We have an inside day, an outside day. Now we have this kind of a slightly higher high and a slightly lower low. Now in the hourly chart, there is some evidence here that this is turning into a triangle. You can kind of see, lower highs, higher lows. But again, we're also seeing here, you can see this MACD is giving us that kind of sense. And I'm just pointing these things out because to me, and I'm not trying to be overly bearish, but the thing I'm saying here is we're in a spot where we're not getting confirmation of the necessary upside. And the other thing I'd say is if you really look out into earnings season, I don't have it loaded up here, but the real thick of earnings season doesn't start until 2 weeks from now when these other companies, let's actually go over here to our MT main. Remember, if you're going to go to earnings dates, and I'm just going to bring in, for example, the NASDAQ 100. This is one of the tabs on the MT main. And if we just kind of look, the really big guns. Next week we have Tesla, but the really big names don't come until the week, like October 30th here, the week beginning Monday, October 27th. So the thing is all right, we kind of have like 10 calendar days. I mean, that can be a long time. A lot of things can happen involving China and things like that before we get the big tech earnings. And so to me, that's also something to realize is we're stuck in a range. We're seeing some bearish signs, and we have a big gap of time before we have any clarity on any known news. Remember, Friday of next week on the 24th, we also get CPI. So we have this huge gap of vacuum of news here. Okay. A few other things I want to just kind of mention here on the MTES version 2. Let me go back and show you here. Is that this is one of the original charts we had. And what this is meant to do is when the moving average, when the 50-hour is falling, like right here, you can see this shows you this oscillator here, this solid line is an oscillator. It shows you the speed of the moving average. and this is the average of the velocity. And when this thing is solidly red and stochastics goes overbought, it's a bearish signal. That's how it works. Or the vice versa. There's other times, like right here, okay? You had a green solid 50-hour, this red line was rising, and then the stochastic went near oversold. It had that spike down, and it kind of gave a signal. And there's other times, I mean, this is one thing we've talked about many times, that it's one of the things that we've kind of created for this webinar, and I found it to be a kind of useful rule of thumb. But if you look at this now, the 50-hour essentially tried to climb here, and now we're just kind of crumbling through it. Now we're breaking through this level from yesterday afternoon. And so from my view here, um, this is now something where this is kind of showing us more of a kind of potentially not great scenario. You can also see the 50-hour, the 100-hour, the 200-hour are now in a bearish configuration with the faster moving averages below the slower moving averages. When you're in a bullish configuration, it's just the opposite. You see bullish 50 above the 100, above the 200, and now we've had that crossover. It's kind of like the moving average ribbon thing. Another thing I want to show you is that Bitcoin is showing signs of weakness. And to me, this is also something. BTC USD. This also here is not kind of bouncing, and there's, it had this only slightly higher high. I gotta say, when I see things make highs like this is not, in my view, a bullish sort of thing. When it makes a higher high, but just barely, and then it pulls back. Makes a higher high, just barely, and pulls back. And now it goes back, and now it made a lower low. I mean, this move here, this slightly higher high in Bitcoin, and then the lower low in Bitcoin, this is not, this is a potentially, kind of sign of also of some weakness. I don't get too much into crypto, but the thing here is that, again, something like Bitcoin, it has had a certain kind of correlation and indication of where the market's going. So I think that's also something to kind of bear in mind here. Now, another thing I want to point out over here in our key ETFs is that look at what the top ETF in the last week is, or the best performers. It's utilities, it's real estate, and it's consumer staples. Those are risk off safe havens. When the safe havens start outperforming, you got to be careful of that. What is doing worse? It's energy and financials and even tech now. Okay, tech is now lagging on the trailing 5-day basis. So this is telling us some things here. Now it's not like overall bearish, but these are all things that if we look back, if the market ends up, having a drop, we can look back and kind of see, wow, there were, potential warning signs. So I think it's interesting to realize that. But the other thing I'll mention from an overall perspective is that, healthcare, XLV, we had talked about it holding on the weekly chart certain levels. And, it did pull back a little more than expected. But if you look here, a little bit more than maybe had been indicated. But if you look here on this drawing and we go to Fibonacci price retracement lines and you look at this rally, basically, it's holding above 50% of it. So from my view here, what we're seeing in healthcare and biotechs, this is a new area where people are kind of taking a degree of refuge, and people looking to be bullish are kind of targeting that area. But today, the other thing is that you basically had weakness in these regional banks. So Zion Bank had more losses. Now we've talked about this because the fact is that credit is it's like a broad market. It's not just one bank. You can have a few things that are just wacky things, and maybe there's fraud, and one bank blows up. That happens sometimes. But we've now seen this with private lenders having issues, all these sort of things. And the thing is that Jamie Dimon talked about it. I can't remember Bank of America. I don't want to talk about Bank of America, but the fact is we are seeing more signs of credit stress. So that is something where we have to realize financials and banks, that's going to be a potential issue. And it doesn't mean they're like going to go to zero. It just means that they have to set aside more provisions and things like that. And it becomes just a higher cost, and the business is just not as good as it was. So the thing is that there are reasons to start to see worries. And the other thing I'll mention is the private credit market has been growing like gangbusters for a long time. And we don't know very much about it. And we haven't really had a real recession private credit started really growing, around 2010, 2012. COVID was a real recession, but we had all the, bailout money to keep people out of bankruptcy. But this is different now. We're seeing weak employment. We're seeing, things that suggest it can be, a weak holiday season, right? So these things we know, I mean, based on predictions that have been made. And now we're starting to see, things popping up in the credit market. So I think that's the other thing that's out there that does remain an issue. Last stock I want to mention though is Eli Lilly, LLY. This is just an interesting one. I mean, it's been a long time, kind of strong, performer, and it has this long downtrend here that it is potentially kind of breaking. And I want to just kind of mention this in Eli Lilly, depending on how exactly you draw. But I mean, to varying extent, the downtrend it's had this year, it seems to have broken above. So I think this is just another, it's a healthcare stock. So I think it's, obviously something, it's a safe haven, non-cyclical part of the economy that people might kind of look to. And overall, we 2 weeks ago, we did the webinar and we kind of compared emerging markets versus the Russell 2000. And I want to just end by going back to that ratio. Let's actually go here. There's a ratio here. All right, let's look at the ratio of IWM against the EEM. Or no, EEM against IWM. And we had talked about it on the weekly, how you can go to a monthly chart and you can see this long-term ratio of emerging markets really lagging. But now there being some signs of the emerging markets actually outperforming. And so I want to just kind of mention that is that, the different dynamics of things happening geopolitically, dollar, everything else. And that is something right now that, emerging markets may still be in that spot where people favor them. And the other thing about emerging markets is, I mean, I'm not talking about gold because we've talked about before, and I don't see anything necessarily in gold right now that has any kind of clear opportunity at this moment. I mean, it's just going straight up. It kind of looks like the US dollar against the Deutsche Mark in the 20s, but that's another conversation. The point is that this is a sign of people going de-dollarizing and things like that. Well, emerging markets also kind of fit into that overall theme. And so I think right now with this geopolitical stuff, it shook up emerging markets because China is a big part of that. But let's see when the dust settles. Let's kind of see what happens here because there might still kind of be this sort of overall relative strength in emerging markets against things like small cap. So I want to just kind of point that out. People looking for that kind of secondary, kind of alpha, index to look to, that might still be in effect. So let's not forget about that because, um, like I said, we go back 2 weeks ago, we did the webinar and we showed things like the valuation differences and things like that. So that's just something to think about. So hope everyone has a great day. We'll see you Monday in State of the Market and have a great weekend.